Hello my dear friends, welcome to Prashant Vediga Business Lessons for You channel. Today I'm going to talk about a very good topic. Suppose you wake up in the fine morning, you find that got your mobile phone and it clinks, you got credited 1 crore rupees in your bank account, or 50 lakhs, 40 lakhs, 30 lakhs, whatever be the amount. Yes, you might have got a new job or a pay hike or a windfall gain in your business. So with that amount, what you are going to do? My dear friends, earning is very easy, but when you manage the earned money, how you are going to do that? That is very important, isn't it? Today I am going to talk about exactly the same topic called asset allocation. So let's go to the topic right now. Yes friends, today we will talk about 5 fundas about asset allocation. So what are those 5 fundas? First we will know what is asset allocation. Asset allocation is nothing but it is the decision making process of allocating money or your current whatever available assets into different asset classes. The main aim is to reduce the risk and maximizing the profitability. That is minimizing the volatility, maximizing the return in the long term. In various asset classes like equity, debt, gold, cash or real estate, wherever you want to, you are going to spread into different asset classes where all you are going to invest and what is the best optimum. It's depend upon the person to person. This is the crux of this entire video. Please still watch till end of this video. So we will see a lot of insights how you have to manage the money, monthly budgeting. So you will see a lot of exciting charts in this video. Please wait till end of this video. There is only 5 slides are there. So it is a very short video but very useful for your well-being and growth. Asset allocation, as I said, asset allocation is a key component of financial planning. It involves the process of decision making, deciding how much money to allocate across different asset classes such as fixed income, gold, cash. By properly allocating funds across these assets, investor can build a portfolio that is tailored to individual needs and risk tolerance. This approach helps to minimize risk while maximizing return over the long term. The key is minimizing risk, maximizing returns over the long term. In short term, my dear friends, is very risky, right? You can't make money. Why asset allocation? This is very important. You should have reasons for asset allocation, no? Number one reason is diversification. As the saying goes by, don't put all eggs in one basket. You have to diversify your assets in different classes. Second is a risk management. Risk management sweet word means what? It is reducing the risk of loss of capital. And then taking risk for yourself also I have included a little bit. Being an insurance man, I also told about why it is important to have insurance for you. How much you should take insurance. Yes, definitely I will cover for that in this coming slides. Thirdly, maximizing returns and long-term investing. So these are all the 4 reasons why asset allocation is important. Does one size fit all? So is there a formula? Does it going to fit everyone? No, my dear friends, because every person is different, every person lifestyle is different, background is different, risk appetite is different, age is different, family background is different. So based on individuals' risk appetite, risk tolerance and what is his age, what are the financial goals, so based on which asset allocation has to be done. And the best person to do is your investment advisor or the person like us. Definitely will help you, our advisors will help you. No asset allocation vary to person depend on following factors. As I said, risk appetite, how much risk you can take, that is called risk appetite, age, financial goals, lifestyle and family background. How to do asset allocation? $1,000,000 question, my dear friends. I don't have answer, but I'll give you broad principles how you should do. You have to combine various asset classes like debt, equity, gold, annuities. Annuities also very, very important. You are going to live long, my dear friends. Then you should money for to cater your retirement life. It's based on risk profile. Then investment avenues can be equity, debt, mutual fund, ULIPs, My dear friends, many people would raise hand where this ULIP come because your insurance man ULIP you have inserted. No, my dear friends, I have made a very detailed video on mutual fund versus ULIP. Please go and see that video. Very important. Each has got its own merit, and it also addresses the taxation, long-term capital gains, where it is taxable or not, how to do switching. So everything covered in this mutual fund versus ULIP, which also provides insurance. And then ETF, equity. It is in exchange traded fund. Sorry, I am just fumbling. Exchange traded fund, gold saving funds in any ratio as discussed in this spreadsheet. Don't go away. This is an important spreadsheet which I am going to show it to you, which I made that. I will share this spreadsheet to you, provided the link box. There is a link is given. Please give your details and email ID. I will send it back to you. Now we will see the. Are you able to see? I'm just going to maximize it. Yeah. So suppose Mr. Ramesh Kumar, named 35 years of age, is having 1 lakh rupees per monthly salary. So just for easy purpose, I have taken 1 lakh. I can put it 2 lakhs or 3 lakhs, but I thought that 1 lakh would be a round figure. He is 35 years of age. He is planning to retire at the age of 65. So we'll just see what all his current assets. Current asset means how much is going to current. So cash assets he has got, say savings he has got around 2.25 lakhs, and current account isn't since he is working, and cash 10,000 rupees he has got. Total cash assets he has got somewhere around 2,35,000. Then debt investment he has made in liquid 1 lakh, and then 3 lakhs in debentures and PPF he has made 3.5 lakh. Total debt investment 7.5 lakhs. And then mutual funds he has made 3.5 lakhs existing, and then 1 lakh in ETF, exchange traded fund, 4.5. Total current assets he have got around somewhere around 14,35,000 rupees he has got assets as on date savings. So what is the percentage? In cash assets he has got around 16.38, and 52% and odd he has put in debt investment, and 31%. This is just an example, my dear friend. And retirement age 65, which I have discussed. What is the recommended one? So here I have made, there is a thumb rule, my dear friends. In this thumb rule, here irrespective of age or family background, 100 minus age, 100 minus age taken into account, how much you should invest in equity, how much you should invest in debt funds, right? So based on which, if we do the recommendation, out of which around 14.35 lakhs he has, 65% he can invest according to the formula, age minus 100 minus age, and 35 for debt. Here in equity, I just made an ULIP, he can invest 25% of his assets, and then 25% in ELSS, equity linked savings scheme. Then SIP, that is monthly SIPs, cumulatively per year he can invest somewhere around 2.32, because he can do rupee cost averaging and balanced fund. Debt and equity is a kind of you are giving a fund manager liberty to invest depend upon the market condition. The balance fund also I have put it in equity just to take care of it, just in case, just to give the fund manager the allowance to do the little bit of juggling. So 25%. So put together 65% he can invest in equity, and then guaranteed, that is debt funds, in guaranteed he can invest in 25% of 35%, whatever the left out here, the 35% is 5 lakhs. Of the 5 lakhs and odd, he can invest 1.25 lakhs in guaranteed, 1.25 lakhs in gold, and annuities and liquid. This is, my dear friends, basically how you should have, if you got any funds available at present now, based on which you can just change your age. If it is 45, it automatically changes. See, my dear friends, so in here debt has increased and then equity has reduced. Suppose if it is 55 years age, let's see what happens. So 55 years age, the debt has increased because 45% only I am allowing for the equity funds, and 55% in the debt funds. So if it is around 58, it will go even lower. So that is how the thumb rule is, age 100 minus age rule, on which this spreadsheet is been made of. Supposing if he is of around 25, so he can take more risk in his life. So maximum 75% he can put it in equity, and then 25% in debt. So that is the kind of a allocation he can make. It is only a broad guideline. Do your own due diligence and then come to us. If you want anything on this asset allocation, you can come back to us. We can give you a customized one. And going to the next slide, sorry, next, monthly budgeting. My dear friends, it is not only the asset allocation, you should also have some thumb rule on how you should do your monthly budgeting so that these funds can be invested properly here on this left column. Supposing he has got our Mr. Ramesh Kumar, he is 25-year-old and 1 lakh rupees is earning. So what will be the monthly budgeting? That is how you should do. First of all, your EMI should not exceed 30% of, let it be whatever may be your age, 30% of your net income. That is whatever coming to your bank, your net EMI should not go beyond 30% of your net income. So here in this case 30,000. So supposing 1 lakh is the salary. And then needs. Needs means your basic grocery needs, so commuting, petrol, all those things. So it includes of 10% of wants. Needs and wants, needs are necessary things. Without that you can't move on. And then 10% are desirable, like going to a movie, going to a park, going to eating out, everything 10% allocate it, right? So I have put together 40% for this, needs and wants, 40%, 30% needs and 10% wants, 40,000 rupees. So within that 40,000 rupees, you have to have control on your expenditure. And then short-term savings. Short-term savings means what? In 5 years, whatever the, suppose you got a small children. Suppose in this case, Mr. Ramesh Kumar is 25 years old. So if he is want to put your child in KG or primary school, so short-term, 5 years he may have to have money, no? So he can save 15,000 rupees on short-term and then for long-term. So that is how the total 1 lakh salary is being divided, should be divided into different kinds of expenses. So first you should save this 30,000 and 15% in long term, 15% short term. It is apart from your statutory savings like PF from your office or NPS. So all those things are statutory. जो बैंक में जो आता ना पैसा, उसमें से क्या करना उसको वो बताया मैंने. It is not that yes sir, my bank, my office is already they are catering for PF, already they are catering for health insurance, already they are catering for my retirement NPS. So it is beyond what you are going to do with your money. So if you are getting 1 lakh means how you should do. This is my recommendation, my dear friends. Do your own due diligence to invest in particular investment sector. And then emergency fund, you should have 6 months of your salary. So come what may, you should build slowly you should build 6 months of emergency fund. It may be liquid fund, so where you can redeem it immediately T+2, or it can be FD, or it can be anything. So 6 months salary should be your emergency fund. And then life insurance, you should have at least a minimum 10 times of your annual income. 10 times of annual income means what? Here this person is earning 12 lakhs rupees per annum. 1.2 crore should be his yearly, life insurance. And then health insurance. Health insurance should be 50 times of monthly income. Why I am saying monthly income? 50 times of monthly income means 50 lakhs rupees. Nowadays medical inflation has gone up. In case of anything medical emergency, there are two kinds of expenses happening. One is that medical expenses directly related to your ailment and treatment, and second is that non-medical expenses, so which is not connected to medical expenses. Because of that incident, so many other things are happening, like transportation, loss of income, and then supposing one of our known person got admitted somewhere, though he was got admitted in government hospital, but the commuting from to and fro that places took us more than 10 times of actual expenses. And then how much how many days you are taking leave, how many attenders they are. So that is why there is an exact reason LIC has come up with the Arogya Rakshak plan, which also covers the benefit based plans. Even if you got some medical insurance or cashless insurance somewhere, here you can claim additional benefit plan based on your admission charges, and then these money can also be taken from LIC of India. That is a very good investment, very good insurance which covers twice. One is that from medical, if you are taken in some cashless, they are also giving cashless benefit, and then here you are getting a defined medical benefit cover also. So either way, your non-medical expenses will also get covered. So if you want to know about this video, there is a Jeevan Arogya Rakshak video is there. Please go and see that. Now we will see the how the monthly. I have made some chart. Yes, in this chart, your current allocation, as we discussed here, this person has done 2.35 lakh cash he has got in savings bank and at home as a cash. Then 7.5 lakh he has made debt investment in FDs and liquid fund, debentures and PPF. Mutual funds and ETF he has invested. Here, this is the current allocation and how it should be allocated. And before that, we will just see the I have my recommendations on the monthly budgeting. So monthly budgeting आप ठीक कर दोगे, then it will take care of your the long term investment and asset allocation. Automatically it will get done. So here, if it is if this pie chart is your 1 lakh or your salary, then 40% you should go into needs and wants, in which 30% should be need, 10% wants. So wants, I would say that it is a desirable expenses like going to movie, purchasing something you wanted to have. So this kind of desirable expenses within this green area. Then EMI, no matter what may be your income, 30%, it should not go beyond your 30% of net salary. Any EMI, let it be housing loan or car or two-wheeler, everything should be included in this 30%. And then long term 15%. Long term means 10 years and above, ideally 15 years, right? Then only after 10 years only the compounding effect takes place. The compounding effect means, so even a 1 day movement will give you so much of 1 month EMI, is the SIP will get added. So the compounding, to take that effect, minimum you should stay invested in equity market for minimum of 10 years. So you should stay invested 15 years, definitely will get benefited. And then short term savings for your immediate needs, you can apportion even for emergency fund also, building up emergency fund, and then you can also invest in liquid funds for your 5 year, that is a short term is 5 year, I would say, right? So this is your monthly budgeting, my dear friends. And here insurance needs, you should have, if you got 1 lakh means 50 lakhs rupees should be your health insurance. That is very important. As I said earlier, the medical inflation is going up every year. So first corona we have seen only the x-ray they wanted us to take. In second wave, the bouquet of test was made mandatory. So health insurance cost is health expenses, medical expenses going up, so that we should also increase our health insurance. And life insurance 10 times of your annual income, in this case around 1.2 crore, and emergency fund of 6 months of your monthly income should be there at any given point of time. And here, yes, here in this recommended asset allocation, I have said for this 25-year-old kid, 25-year-old person, ULIPs, how much it should be, and then ELSS, SIP. This slide is spreadsheet is very useful, my dear friends. I will share it with you. Please go into the description box and give the given link, fill out the details. I will email it to you. Supposing if you are taking somewhere around 45 years of age, and everything changes out here, not in this slide. Here it will get changed. Yeah, there is a, see, there is a debt is increasing here and equity is coming down. So this is how the thumb rule, it is not a thumb rule, it is a broadly accepted rule. 100 minus age is the asset allocation, you can do it. These are all the, not the exact one, you can find any other venues also where you can invest. And this is all about this spreadsheet, my dear friends. If you want to make any changes, I am giving you just in 5 or 10 minutes all the details. If you want any further details, you can always come back to me, I will tell you. And we have seen how to do asset allocation. Then understanding the importance of asset allocation. Understanding importance means life is difficult to predict. Life events are very difficult to predict. Kal kya hone wala hai, which is very, very difficult to predict. And then investment performance, because of external factors, the company may be doing well because of some extraneous events like corona or some other reports from foreign company come and hamper your portfolio. So that's why the asset allocation, even if one asset is not doing well, the some other asset will do better, and then your losses are limited to that. Then you need to protect the downside when things go wrong and capitalize when markets are booming. So it gives a fund manager, that is why the balance fund kind of a thing. So they will manage your fund very much professionally. They will take care of your investment. When the things are going down, they will shift it to debt investment. When things are going up, then they can see that where the market is poised to go, and they will preempt and invest it in future. Market will go up, they can reap all these benefits. And then aim for the best risk adjusted return. So what is the best risk adjusted return? So risk is always there, but how much investment I can make in one fund house? If you say that they are managing around 42 kind of portfolios, they are merging it, and then within the 4 portfolios they are giving somewhere around 12 to 15% of risk adjusted returns. So that is the kind of churning, and then market movements they are foreseeing it, and then such portfolio investment they are making it, they are giving a maximized best risk adjusted return. Any fund manager will do that. If you want to know more about it, you can come to us, and LIC is the best fund manager in the country, so your investments are always safe. And then have a long-term view on each asset class regardless of current volatility. This current volatility, if you see the market, it is going like crest and trough, crest and trough, crest and trough. So in the short term, markets are always volatile. In the long term, markets are always giving you extraordinary returns, my dear friends. So with this, the long term view is very, very important. Have a bird's eye view of market of 10 years and 15 years. You would see that how much market has come back. For instance, in 2010, markets were somewhere around the midst of volatility in the subprime issue. It has gone down from 22,000 to 8,000. Again, now the market has come. Now people are saying market are volatile. 13 years down the line, the market has come back to some, Sensex has come to 60,000 and odd. So it is just going up and down 1,000 points here and there. So still market has given the best returns in this 10 years time. You should stay invested provided you do proper asset allocation according to your risk appetite. So when to review your assets? It doesn't mean that you put the asset, invest in some kind of portfolio and then forget it. So don't do you can't just forget it. Periodically you have to review. So reviewing means some people daily they will go and see the markets. Supposing if you are purchasing a plot or real estate, will you go and see daily basis how much it has increased? So you will see after 5 years only, no? Suppose a residential plot in prime locality if you have purchased, in daily you will not go and see. So similarly, if you are investing in equity market or any asset class, so give some time for it to see some movement. So I would say that 6 months to 1 year is the ideal time where you have to see that asset, where this asset is going, whether it is going or whether it is making loss, how much I should limit the loss. If it is going, what is the put stop loss, 10%, 15%, or exit if it is going down below, or you should you make profit out of it if it is giving you a very good return. So this is called a rebalancing of portfolio. The rebalancing of portfolio can be considered to gain better returns and avoid losses and pitfalls. My dear friends, you have to do the rebalancing. You can contact your advisor, you can contact us, as a development officer or advisors, they will tell you how to do the asset rebalancing. So it is very important. Managing money is as important as earning money. So you can earn money, but putting it in the right places and then monitoring it and rebalancing it requires some kind of professional assistance. That is why there's a financial institutions like LICs and development houses and professionals are available. You can always contact us to get to know the things. We will give you the best of advice. Thank you very much for watching this video, my dear friends. And you can anything, if you can just send me the admin@startupin.in. This is my personal website. Here you can come and see this, and I will also post that asset allocation spreadsheet in my website also. There is a link given. You can go there and access it. It's a free of cost. You can download it and view it. So thank you very much for watching this video. Until then, bye bye.